GM everyone, and welcome to Smart Contact, an interview series with the world's most influential and impactful Web3 leaders. This podcast is produced by Web3 Harbour and is supported by Circle. Like and subscribe for more Smart Contacts.
Welcome to another episode of Smart Contact produced by Web3 Harbour, supported by Circle, our series sponsor for 2025. I'm Tchui, Vice President, Head of APAC Ecosystem for the Hedera Foundation. I'm also the Executive Director of Web3 Harbour. It's a pleasure to be here with a live audience because Smart Contact is about bringing meaningful conversations in Web3 directly to the people shaping this industry. Our guest today is no other than a leader in the space, but also a long-term friend, Alessio. He's a co-founder and CEO of Hex Trust, a company that has become trusted partner for institutions and Web3 firms alike, navigating custody, compliance, and opportunities in digital assets. Over the years, Alessio and I have had many conversations about where this industry is headed. I've always admired his ability to cut through the complexity and focus on what truly matters. In today's discussion, we'll explore how institutions are rethinking their balance sheets with digital assets, how staking is turning idle capital into productive capital, and how tokenized portfolios and on-chain rewards are entering mainstream wealth management products. And finally, we'll look into Hong Kong and its Web3 landscape by 2030. Alessio, thanks so much for joining us today. I want to start by just asking you a simple question. What has been a recent aha moment that has made you again or even more bullish on Web3?
Thanks, Jeff. Hi, everybody. There was one moment. Actually, it was not very recent, but it was back in 2021-22. I'm also the co-founder of another company, a DeFi protocol called Clearpool, which is a lending and borrowing protocol. Back in 2022, we were trying to scale the TVL. So we were trying to get people to borrow and lenders to lend into the platform. And obviously, scaling TVL in a DeFi protocol is not very easy. But all of a sudden, we started seeing the TVL growing very quickly. So we tried to understand what was driving this growth. And we went through actually on the blockchain, you can see who's lending and who's borrowing, right? So we tried to track the lenders that were increasing the amount of money lent into the protocol. And we found out that it was not a bunch of retail people, but it was actually one address that was taking the lion's share of the lending. This address, we were able to basically track it back to a company that back then was called Idle Finance. Today has changed the name, it's called Pareto. But basically what they were doing, they were using the receipts of their loans into the platform, the CP tokens, kind of similar to the compound C tokens that you get when you lend into a DeFi protocol. And then they were accumulating them into an kind of an SPV. And then they were tranching this SPV. So they were tranching the loans into the senior tranche, mezzanine tranche, and equity tranche. And then they were reselling these kind of loans on their platform to other investors, right? Yep. So we're talking about securitization and tranching of a bunch of loans done on chain. And this kind of process in traditional finance takes a lot of bilateral legal agreements and structuring and months to be put together. And you have to keep the loans on the balance sheet of the bank for a long time until you can actually securitize it and sell it to investors. On the blockchain, we were not even aware that somebody was doing it without even asking for permission, but just using and leveraging the programmability, composability, and settlement characteristics of the blockchain. I think that this really made me realize that, all right, it's not just about the asset that you bring into or the service that you bring into the platform, but it's about how much other people can bring in terms of derivatives on top of the assets that you have created. And this can be done in such a free and programmable way that is not achievable in traditional finance.
Do you feel Hong Kong is ready for derivative products off of crypto?
No.
Yeah,
of course not.
I mean,
we just heard that, all right, we're launching a security token in Hong Kong with hashkey and everything. But for some investors, actually, we also have an offshore entity. I think it's going to be a progressive process, right, where we need to kind of first figure out some primitives. Right. So, for example, the first primitive, in terms of services, of course, you need custody, you need broker dealers, right, to be licensed. You need a centralized exchange to be licensed. Without those things, you cannot have the primitives in terms of services. And then you need the primitives in terms of payments. You need the stable coins, right, and you need the assets. But it will take time, but you need to start somewhere. And I think where Hong Kong is today is kind of slowly catching up. And it has the potential to eventually get to that stage of development.
But that's the story of Hex Trust, right? You started in Hong Kong, you saw the market conditions, and then you made investments in other geographies, other jurisdictions to help you continue to grow your business. And let's fast forward. Now you have licensees or in the process of getting licenses in both the UAE as well as Europe and Singapore, and potentially even other jurisdictions as well. So how was that possible? If you look back, right, what was the thinking at the time besides, okay, we can't do this here, let's expand, let's raise money and also get into other new jurisdictions? What does this look like for you in 2026 in terms of collecting all of these different jurisdictions, this ability to operate in multiple places? What's the end goal? Do
you want the truth or...
Well, hey, it's a free conversation, man. It's Christmas too, so it's up to you.
So I think back in 2018, 19, we kind of didn't have a choice, right? So we were looking for a place where we could operate. Back then, if you guys remember, for people that have been in the space for a long time, so Hong Kong was home for some of the most successful crypto companies, right? Think about BitMEX, that back then had more than, it was basically invented the most traded product even today, the perps, right? But also Ember, Animoca Brands, Crypto.com, even Bitfinex at a certain point was based here. But then in 2019, the ICO ban happened and mainland China banned crypto. So we started becoming a little bit worried about the fact that this was our sole jurisdiction and we might be kind of at a certain point maybe we would not be able to do business anymore here, right? So we started looking, okay, where is another place that we can go? And the obvious choice is Singapore, right? And back then Singapore was very amicable to crypto companies, so we expanded into Singapore. And then what happened? Then we had FTX, and Singapore was hit, especially the sovereign wealth funds, by the debacle of FTX and then DCG. And then Singapore started to kind of slow down the licensing process.
To be honest, I'll say this now: Singapore was always slow in issuing those licenses out. But that's my.
There is slow and slow, right? It took us. We applied in October 2021. Right? We got the license in 2025. Yeah. Back then, Dubai was emerging as the it was a new story because there was not only an amicable jurisdiction, it was a new regulator that didn't exist before, and that was put in place right with the objective of attracting crypto companies and writing a new regulation that was basically written from scratch. So it was very attractive. So we decided, okay, let's go there. Then fast forward a few years, obviously today we need to be a global player. So if at the beginning it was kind of out of necessity that we had to go to other jurisdictions, today we need to cover our clients and provide our services in a global way. So we need to be basically present and licensed in the key jurisdictions.
But did your clientele change over that process? And what about your technology stack, like overall, in terms of offering custody services and whatnot? What is the Hex Trust from in terms of the operating structure of Hex Trust from like 2020 versus today? I imagine it's completely different, but I'm just curious to see how you would describe it.
Well, first of all, in 2020, we were probably 50 people, right? So today we're 3 times as big. But it's from a geographical perspective, we spoke about it. So we need to run a global business with different licensing requirements in different jurisdictions, which basically make the whole operating model extremely complex. From a services perspective, back then, we're only providing basically custody. So wallet management and custody and very basic
HSM-based custody back then.
HSM-based custody, yeah. And so it was kind of basic and static. There was no kind of staking. There was no wrapping. There was no bridging of assets between different blockchains. Today, we provide the whole custody related services. So it's not pure custody, it's just custody, staking, escrow, collateral management, etc. Then we have a whole division for market services that allow our clients to trade, to hedge their exposure, to borrow, to lend, etc., to buy investment structure products. And then we have a new division that we're launching in January next year, which is going to be a wealth management, private wealth offering.
Oh,
yeah?
Interesting.
Well, you didn't know about it?
No, I mean,
Yeah,
I'm
good.
saying, yeah. Interesting for the audience and everybody who's involved.
Right. Yeah. So basically, having all these services makes the whole business model much more complex. It's quite similar to what financial institutions or wholesale banks do. And the company has been completely transformed. From a technological perspective, after FTX, we were lucky enough to make the decision not to take too many risks, instead to kind of go back and basically think about what we could do during the bear market. And what we did is basically to rebuild the whole technology stack from scratch, from the ground up. So the old platform has been retired probably 18 months ago. We started from scratch and we built a platform that today is competitive because it has been designed based on the requirements of 2022 versus a very different set of requirements that we were subject to in 2019.
Fantastic. I'm going to bring it back to Hong Kong. So we've gone a full circle. We've started, you going around the world, so I'm chasing you back to Hong Kong where we are today. You've been recently appointed as part of the Hong Kong Web3 Task Force, right, to help shape policy moving forward. With your experience, with your basically all of the things that has happened to not just you, but your company, what insights have you been giving this task force? And how has your involvement in this task force changed your perspective on Hong Kong as an international financial hub for Web3 assets?
So it's quite funny because actually my first job in the financial market was actually, I don't know if you know it, I used to work for the regulator myself. Yeah. So after 15, 20 years, I'm back to the initial spot. I always thought that Hong Kong is really in a very privileged position because for a number of reasons. Obviously, it's one of the main financial hubs globally and probably the largest financial hub in Asia. It's international. I mean, we all know common law, proximity to China, innovation, etc. Even in crypto, it was home for some of the most successful companies in crypto, etc. However, I think we took a little bit of a very slow approach to regulation and to kind of
also
foster.
have 3 regulators, so
You have 3 regulators
Or
that
more,
are extremely careful in protecting the retail population, right? But what happened is that they started basically regulating what has the main impact on the population, which are retail exchanges, right? And the rest of the industry has basically stayed in a completely unregulated for the last 5-6 years, right? And this is not the case for other jurisdictions. I mean, in Dubai, we have full regulations for all services, in Singapore as well. Hong Kong has a big advantage, but it was a little bit slow in kind of implementing what it should have been implemented. Now, is it too late? I don't think so. But at this point, I think Hong Kong doesn't have the privilege to make mistakes and then to go back and rewrite the regulation, right? Because lots of companies have left. They're ready to come back, but they need to see really a real kind of path forward in Hong Kong to basically run your business in a commercial way here in Hong Kong. So now what the Web3 Task Force is about is really to collaborate with the Web3 industry to gather all the best practices from other regulators, to gather the best practices from the players in the industry, and trying to translate it into a regulation that not only basically defines what people can do, but also kind of gives you a way of running your business in an economically viable way.
Thank you for that comprehensive regulator explanation. I was very excited to actually be able to talk to you about this because knowing also your background and your passion for policy regulation. And thank you again for the effort and focus that you put into even Web3 Harbor's stablecoin working group, as well as our custody working groups. So I want to move our conversation into something that you've been speaking quite frequently about. A couple of weeks ago, you talked about liquidity reset. We had a very interesting market event that happened in the beginning of October. It affected so many Web3 institutions. And one of the most affected I guess, trends or asset categories was DATs, digital asset treasuries. I want to start off by asking you, in your perspective, are DATs or DATs something that institutions should be holding? Do you think it's a good use of diversification? And as we maybe move into wealth management products and solutions, what areas of concern do you have between volatility and actual security?
To be honest, I see DATs as a kind of, not really as a business, but as a financial engineering exercise. The first DATs were very successful because it was something that didn't exist before, and because they were able to capture the broader audience of Wall Street rather than the audience of crypto people, right? But eventually, we knew that if the sole purpose of a company is to hold an asset and there's nothing else inside that company, the value of that company cannot be much higher than the asset itself. So what is the point of buying the company instead of buying the asset? Yeah. So I think it was a very good experiment, and there are some possible use cases for DATs. For example, if there is a tax or legal arbitrage in holding the equity instead of the underlying asset. But I wouldn't say that it justifies the tens of billions of dollars that have been poured into this kind of asset class in the past 12 months. The thing is that the first DATs were not much leveraged. They were at least structured in a proper. But then the following wave of DATs, they had to raise capital and kind of at any cost, right? Yeah. Which means that they started kind of getting on their balance sheet a little bit too much debt. They started to kind of negotiate terms that were not as favorable as the terms the strategy is able to negotiate.
But you also had saturation in the market. So, there was so many DATs being launched. MNAVs, basically VCs getting term sheets, were just looking at the MNAV number and making their decisions based on the higher MNAV. So I guess it was also a lot of hype, no?
It was a hype. So the first ones were okay. The second one, the terms were even worse in terms of leverage, etc. And when you have something that is leveraged, I mean, it's the same thing, right? Either whether you buy perps on margin on Binance or you buy some kind of highly leveraged debts, it all ends in the same way, right? When there is a big shock in the market, the prices go down, people get liquidated, everybody needs to sell, and this kind of causes a cascade of events. And many people get hurt much more than they wouldn't have. They hadn't if there was not so much leverage. But on the positive side, I think DATs, they really opened the doors to normal corporates that have real business models, they have free cash flow, they have treasuries in cash, and that needs to be diversified. And if we didn't have DATs that did it for the first time, probably Apple or Google or all the other companies that would not be able to do it without the previous experience of DATs. Apple and Google are sitting on 70, 90 billion US dollars of cash on their balance sheet, right? Imagine if they start to invest some of it into Bitcoins or some crypto assets, right? That would be really revolutionary, but they wouldn't be able to do it if DATs had not done it before them.
Sorry to interrupt, but I want to tell you about our smart contract lead sponsor, Circle.
What is Circle?
At Circle, we're building a digital dollar that brings the power of the internet to money.
Circle's the place where crypto meets stability,
where local businesses meet global customers,
and the US dollar meets USDC.
Meet Circle.
Thank you to all of our sponsors and community partners. Now back to the conversation.
What does a good DAT look like, right? Is it underlying business generating revenue that buys back tokens at an MNAV that's attractive? Is it enough usage of discounts and token warrants? Does it have perps and options trading in the background for treasury management underneath? Like, you talked about financial engineering, but you also talked about stability. What is that right balance of the right DAT?
From a trading perspective, you want a DAT that has a lot of kind of volatility profiles and having lots of leverage, lots of different instruments that can be traded. But that's not really very interesting, at least in my opinion. In my opinion, it's really to have companies that have real businesses and that diversify their profits, the cash that they have on their balance sheet, in different types of assets, right? This is a DAT that I find sustainable, right? And that I think has a future in terms of kind of financial asset, investable asset for investors. Yeah.
So we'll move to something more, let's say, common for many of the retail and Web3 mass: staking. So I think you and I can agree staking is still relatively perceived as a retail activity in most of the ecosystem. As staking is part of a no-brainer, it's basically table stakes, really, right? For most of the virtual assets that are actually coming up through institutional adoption. How does Hex Trust make staking sexy for institutions?
I'm not sure we can make it sexy, but we can make it usable and safe, right? At the end of the day, institutions, they need a number of things. The first thing is that obviously they don't need to lose their assets, so they need the safety, the security of somebody that is experienced in running that kind of a wallet business, and that's what kind of our core competency is at Hex Trust. Then they need the workflows and the optionality of basically taking their assets and being able to stake them first, right? And then to be able to choose among different validators, right? Or to diversify across different validators. But that's just the beginning. Then the institutional needs are a little bit different from the retail ones. So institutions, they need, for example, some advanced services, for example, compounding, right? You stake, and then you redeem your rewards, and then at the same time, these rewards need to be reinvested, restaked automatically, so that you increase the amount of rewards that you're earning. Or some institutions, they might need to, basically, for some institutions, staking actually represents their cash flow, right? And they cannot be subject to the volatility of the underlying asset and the volatility of the yield that the blockchain protocol is paying for that specific asset. So some institutions, they might be willing to hedge their exposure. Okay. So they will come to companies like us and say, okay, you take the cash flow coming from staking rewards, and you give me US dollars every time you receive it, but at a certain rate that we decide today. Or some institutions that they might say, you know what, I can't be bothered waiting for 3 years until all my assets have earned the rewards. Give me some US dollars today, and I'll sell you all the rewards for the next 3 years. So these are kind of services that a financial institution can offer to institutional investors, and they're really at the core of the needs of institutional investors.
I guess I used the wrong word. Sexy is not the right word. Probably like functional and attractive is the right word.
Yeah, maybe.
And I'm glad because Hex Trust's pedigree with all of your professionals and your talent inside the organization, you're able to really map out that specific pain point with these enterprises, with these institutional firms. Bonds, equities, staking. Do you think there's a place for all three, or is it one or the other?
I think bonds and equities, they will run on protocols that will have native staking in the protocol itself, right? So basically, by holding these bonds or these equities, you'll be part of an ecosystem, right? And when you're part of this ecosystem, if you perform a role in the ecosystem, for example, by providing capital via staking or by providing liquidity into some liquidity pools, then you will be rewarded, right? That's the real one of the real differences between the traditional financial system and blockchain, right? In the blockchain, you're part of the ecosystem. It's not just the banker that gets the fees, but if you're really part of the ecosystem, you can actually share part of the success of the ecosystem, right? So I think bonds and equities, since they are substantial in size, they will really create the real ecosystems. It's unthinkable of having all these blockchain protocols that we have today, 250 blockchain protocols with very limited activity, without having the real assets, the equities, the bonds, the commodities being tokenized and being brought to these blockchain protocols. Once that happens, you have your equities, your bonds on that blockchain protocol, you'll be able to participate in the ecosystem activities and earn your staking rewards.
I mean, obviously excited to see Hex Trust continuing going down that journey. And one of the destinations or waypoints in your journey you mentioned earlier was the wealth management business. So, I've spoken with wealth managers, traditional and technically Web3, like basic multifamily offices, etc. And the use cases that I've seen are mainly around efficiency of idle capital, or maybe on like ledger innovations for them to manage their business better. But how, in your mind, in a future state where more and more actual virtual assets are inside the portfolio mix to get that kind of diversification, efficient frontier, etc. When will we be able to reach a place where wealth managers are using virtual assets and digital assets in replacement of those traditional assets in the portfolio mix? And then what is that right combination of diversification and risk?
Very complex question. But so I think two things need to happen, right? So the first one is that this is happening today. We're bringing digital assets, especially Bitcoin and some of the major coins, into traditional portfolios, right? For a diversification perspective, right? So this is the first movement, digital assets into traditional portfolios, right? The second part is the traditional assets onto the blockchain. So the final destination is that we will have digital assets and traditional assets together in the same portfolio, but everything will be on the same chain or on different chains, but it will be on chain. So why is that better? Obviously, the diversification, the value of having digital assets is important. I mean, the flexibility of using means of payments such as stable coins is obvious to everybody that has used the wallet, how much easier it is to transfer money, right, rather than using bank accounts. But the real difference is, I mean, banks are kind of trying to optimize for payments, right? Especially, for example, in Hong Kong, we have a lot of domestic payments tools, right, that work quite well. And more or less every country has the same type of technology as of today. The issue is when you need to get out of one asset class or you need to get out of that country, right? So imagine today if you wanted to move your HSBC shares from your Standard Chartered account in Hong Kong and transfer it to my Italian bank account and my UniCredit bank in Italy, right? So a transfer of US dollars can be done. It takes 2, 3, maybe 4. You don't even know how long it takes and how long it costs, but eventually you will get your US dollars to Europe. But a share cannot be transferred. There is no way. Maybe there is a way. I mean, you have to go to a bank and fill in 50 pages of forms to transfer, to agree with the custodian, the depository to move the, but it's going to be extremely complex. Why? Because every single country has built this kind of silos that do not communicate with themselves. So once you bring all these portfolios on chain, all of a sudden they become programmable, they become usable, and it's the same thing as where we started the aha moment, right? So you have somebody that can actually take your assets and can securitize them and can trench them. So in the same way you have your portfolio, all of a sudden you'll be able to use your HSBC shares to borrow money from somebody else, or you'll be able to transfer it across to different people, etc. So this is only possible if you use the same infrastructure, which is the blockchain as of today. And it's going to be revolutionary in how we think about assets that today they're static ledger entries, right? But tomorrow they will become programmable assets that we can use in our daily lives.
Do you have an idea of what potential new products or incentives could be built on top of a world where you just explained, where both these assets live together, and how Hex Trust would be part of that solution?
No, but I mean, think about how fragmented the payment industry is today, right? So something that we all understand, right? So you're in Hong Kong, you want to go to the 7-Eleven, you want to buy a Kit Kat, right? I mean, you need to use your Octopus card. You need to have Hong Kong dollars, and the merchant, they will receive Hong Kong dollars on their bank account, etc. That's it. It's been programmed like this. It's been wired like this, and there's no alternative. But why can I not use my HSBC shares, my HSBC account, to pay for my Kit Kat? And why can the merchant not decide to receive euro instead, right? So if you think about a portfolio that is tokenized, then you will have a very simple infrastructure that with today's technology is possible, whereby I pay with my tokenized HSBC shares a 0.000, I don't know, unit of my HSBC shares. It goes into a decentralized exchange, a DEX. It gets swapped into a stablecoin. It gets swapped into euro stablecoin, and the merchant receives euro. Right? This would be instant, without paperwork, and at a fraction of the cost, right? And I don't even have to know what the merchant is receiving, whether they're receiving euro or something else, and the merchant would not even know what I'm paying with. It's just completely connected into one simple infrastructure.
I won't go into the capital controls part of that question, but
in Hong Kong.
In Hong Kong, yeah. But as we near our soft landing for this conversation, I do want to come back to Hong Kong for a little bit. In the most recent chief executive policy statement, the focus was on sustainable and responsible growth. But then we also know there's multiple different trends, right? There's scams happening all the time. But the trends in tokenization, stablecoin issuance, digital infrastructure, market architecture, let's give you a couple years, by 2030 for Hong Kong, what is that catalyst driver that's really going to push? And you can't say everything, you got to choose one. So what is that catalyst driver that's really going to push us and make us not only the place to come for digital assets as an international financial hub, but also help us maintain its attractiveness, like our attractiveness?
I think it's market infrastructure, because the tokenization already exists, right? We need to think about, okay, why not many people are tokenizing things, right?
I mean, assets are not that great to begin with.
Assets are not that great, but okay, but we can tokenize anything. Why don't we tokenize great assets, right? Then the stable coins, all right. I mean, I'm very happy that we'll have a stable coin in Hong Kong, but you know what? I mean, Hong Kong dollar is not even really it's already a stable coin, right? It's not an international accepted currency, right, for commercial flows and trades, the settlement of financial transactions. So let's put it this way: it's not going to be revolutionary, right, having a Hong Kong dollar stable coin. But market infrastructure is necessary because you need to bring to Hong Kong the necessary players, right, to be able to build the ecosystem. As of today, we only have exchanges, right? We don't have anything else because we don't have the market infrastructure, we don't have the regulation, we don't have a favorable environment to build that. But you need to have this kind of infrastructure here if you want a thriving ecosystem. So that's really what's going to change the direction of Hong Kong.
It's funny, asset issuers will blame custodians. And custodians will blame asset issuers for the chicken and egg problem of why tokenization is not successful. I think asset issuers will say, oh, well, the custodians don't know how to price us in terms of the real true value of the asset. And then also on the other side, it's literally the same argument, right? So I'd love to kind of pick your brain on that, maybe on another podcast. Quick follow-up on the market infrastructure and market architecture piece. So what is that piece of infrastructure architecture that you think will really get Hong Kong to the next phase of mass adoption?
There's a lot of things that are still missing, to be honest. Yeah, I would say if you divide the blockchain process, is really the first step was technology, right? I think more or less the blockchain technology infrastructure is there. Lots of companies have it, right? And it's available for everybody. The second part was kind of regulation. We're getting there. I would say we're kind of 50% there in Hong Kong and maybe 100% in other jurisdictions. But the third step that is the most important one is really the use cases, right? So somebody needs to figure out and come up with use cases for the blockchain and these tokens that are not just speculation and trading.
Okay.
Yeah.
Fair
so
enough.
I think you need an ecosystem and you need to incentivize people to come up with these use cases. And that's what is going to make the blockchain valuable, right? You cannot just have a casino on chain and expect that this industry will take over the whole world, right? We need real use cases where everybody in this room will be incentivized to actually use the chain for something in their lives. Not for everything, but at least for something. While today we mainly use it, yes, the use case of investing in Bitcoin, the use case of cross-border payments with stablecoin, and then the rest is speculation, right? It's a little bit too little. We need more.
Alessio, thank you so much. More use cases on the blockchain built by investors, builders, intermediaries, and companies like the ones we have in Hong Kong and are part of Web3 Harbour. Thank you again. It's always a pleasure speaking with you. And thank you for joining Smart Contact. I want to wish you a happy holidays and looking forward to having you back real soon.
Thank you so much.